Good afternoon, everyone. Welcome to the Financial Services Working Group specific lunch. I hope you all are excited to talk about cryptocurrency today. My name is Alexandra Geiser. I am the Vice Chair of our Financial Services Working Group, and it is my honor to introduce the moderator for today's panel, Judge Patrick Weyrich. For those of you who have been around FedSoc for a while, you will be used to long bios with no mentions of Oklahoma. So I think you will be really excited for the change of pace. Judge Patrick Weyrich is a U.S. District Court judge for the Western District of Oklahoma. Previously, he served as the Vice Chief Justice of the Oklahoma Supreme Court and as Oklahoma's first Solicitor General. Please join me in welcoming Judge Patrick Weyrich.
Well, thank everyone for being here. I assume if you're in this room, it's because you have some particular interest in the topic, but the panel was really prompted by this year's enactment of the Guiding and Establishing National Innovation for U.S. Stablecoins Act, also known as the Genius Act. And we thought it would be useful. We're going to start with a lightning round with all the panelists and then get into what we think will be a productive discussion of all the topics that the Genius Act has prompted. And I'm going to start with Professor Lee Reiners. He's a lecturing fellow at the Duke Financial Economics Center and is widely recognized as an expert on cryptocurrency regulation. And he's going to give us a 30,000-foot overview of the Genius Act to start.
Sure. Thank you, Judge Weyrich. It's great to be here. I feel like Chris Berman doing the football highlights here, the fastest 2 minutes. So I'll do my best to give an overview of the Genius Act, which really was a bipartisan piece of legislation. So it passed in the Senate in June with 68 votes, and then in July in the House with 308 votes. So what does it do? Well, first and foremost, it defines a payment stablecoin. And payment stablecoins are digital assets designed to be used as a means of payment or settlement, and the issuer of which is obligated to redeem for a fixed amount of monetary value. And then in terms of who's able to become a permitted issuer, there's sort of three broad categories. First is a subsidiary of an insured depository institution. Second is a federal qualified payment stablecoin issuer, and these would be overseen by the OCC. And then third is a state qualified payment stablecoin issuer. So who's a federal qualified payment stablecoin issuer? Well, it could be a non-bank entity, an uninsured national bank, which I know we're going to talk more about, or a federal branch of a foreign banking organization. And a state-qualified payment stablecoin issuer has to be legally established under the laws of that state and authorized to engage in payment stablecoin activity, and they cannot be an insured depository institution or a subsidiary thereof. Now, state-qualified payment stablecoin issuers are able to operate subject to state oversight, provided that they remain below 10 billion in total stablecoins outstanding, and the state regulatory regime is deemed substantially similar by a new group created by Genius called the Stablecoin Certification Review Committee, which consists of the Secretary of the Treasury, the Fed chair or his designee, which could be the vice chair for supervision, and the chairman of the FDIC. A critical point, which I know we're going to talk more about, is that stablecoin issuers cannot pay the holder of a payment stablecoin any interest or yield solely in connection, I'm emphasizing that word solely in connection with the holding, use, or retention of stablecoins. What are the requirements? Well, most importantly, one-for-one backing. So stablecoins have to be backed one-for-one with cash or cash equivalents. So that can include deposits at banks, treasury securities with a 3-month maturity or less, overnight repo or reverse repo transactions in which treasuries are the collateral, and government money market mutual funds. There's also capital and liquidity and risk management standards that have to be tailored to the business model of each issuer and cannot exceed what is necessary for ongoing operations. Stablecoin issuers are limited in the types of activities they can engage in, so it has to be exclusive to just the issuance, redemption of stablecoins, and the management and custody of reserves. Finally, I'll note that there is a prohibition on foreign payment stablecoin issuers to issue in the U.S., but that can be waived by the Treasury Department along with the members of the Stablecoin Certification Review Committee, provided that a determination is made that the home country of the foreign issuer has a comparable regulatory regime to what we have in the U.S. So I think I'll stop there. I know we're going to get more into the details, but if I left anything out, I'm sure my fellow panelists will fill you in. Thank you.
Thank you. Next up is Katie Biber. She's the Chief Legal Officer at Paradigm, a research-driven investment firm focused on cryptocurrency and blockchain technologies. Katie leads the firm's legal, regulatory, compliance, and policy functions. Katie.
I think most folks at this table are very excited about what the Genius Act enabled. Stablecoins are one of the most exciting innovations that our financial systems has seen in 100 years or more. They have many benefits. I think chief among them, they enable us to engage in transactions that are near instant, which is, whether you think Venmo is instant or not, simply not possible with the existing financial system. You can settle transfers in a matter of seconds or minutes as easily as you could walk a piece of paper down the office of your law firm to someone else. There's no holidays for stablecoins. There's no after hours for stablecoins. It's cheaper to send money, to send value around the world with stablecoins than with any other type of value transfer. The most important thing that I'm personally excited about regarding stablecoins, though, is what it offers to the US dollar. In particular, stablecoins can help the US dollar in two important ways. First, stablecoin issuers have become one of the biggest purchasers of US treasuries, which could rescue us someday from a failed treasury auction. There was a terrific op-ed in the Wall Street Journal authored by Paul Ryan on this topic about a year and a half ago, which I would recommend to anyone interested in the topic. And then second, the more the US dollar proliferates around the world, which is enabled by stablecoins like USDC and Tether, the safer the US is. It's really important for our national security to have the US dollar in the hands of folks around the world. It increases our power from a monetary policy standpoint, and it improves national security for everyone back in the United States. Stablecoins do offer some components that the banks have become unfamiliar with and sort of uncomfortable with. We're going to talk about that on this panel as well. We, more than anything, believe, though, that banks can get excited about the innovations that stablecoins offer and join in the fun of providing new products to consumers, which is something that I think everyone wants.
Thank you, Katie. Next up is Paul Watkins. Paul is the founding partner of Fusion Law. He has extensive experience with state, federal, and global regulators, building coalitions and implementing policies in this space. More importantly, I've known Paul for, over a decade now, going back to our state AG days. I'm proud to call Paul a friend. Paul.
Thanks so much, Judge. It's a real pleasure to be on this panel with folks. Thank you especially to Professor to Lee for joining us, and to you all for being here. What a great audience. We've had other crypto panels with this committee, and I think this is the greatest turnout we've ever had. Really excited to see the enthusiasm. And so what I want to talk about is my background in state and federal regulation, which was about promoting innovation. So is this an example that innovation is working in the United States? We passed a law that increases competition against incredibly powerful incumbents, banks and payment processors. That is quite unique. It's hard to find another piece of legislation that banks have lost. You might think of Dodd-Frank, but that essentially reduced new entrants and it increased consolidation. This actually increases competition. That's encouraging, that's a huge win. But let's look at the circumstances that led to this legislation to see if we should view this as a trend or an anomaly. So in Trump 1, when I was working at one of the agencies, the banks had 62% approval rating among Republicans in 2019. And then they began a series of the dumbest government relations steps in history and systematically targeted just about every aspect of the Republican base, using SPLC to get rid of Christian institutions, to debank Christian institutions, debanking guns, coordinating with their competitors to say, we're going to use our market share to reduce emissions, debanking prominent conservatives, including the president and his family, on and on and on, until their approval among Republicans by 2024 hit 38%, 62% to 38%, the same as Democrats. At the same time, they lost 11 points among independents. So the incumbents essentially blew their face off, which is very helpful. Meanwhile, the crypto industry hired a bunch of the folks that the banks wouldn't hire when they came out of the Trump administration. You didn't see the Trump folks going and getting these fancy board spots and all that. That meant the banks were disconnected from the Trump ecosystem. The crypto folks were very connected to that ecosystem. Crypto also has an advantage among innovative products in that the first product, Bitcoin, is essentially making money. So it's not that, hey, we have this idea that might generate cash later on. Our idea is cash. So there are people in this community right away who are well-resourced and who can compete. And then they made what was probably one of the riskiest political decisions ever. We are having so much trouble with the Democrats and the Biden administration, we're going to take out the Senate banking chair and we're going to go all in on Trump. And they've won both of those. And it took all of that to beat powerful political incumbents. So I am optimistic, but if that's what it takes, boy, are we in trouble, because we need to replicate this in so many industries for us to be competitive as a country.
Well, I'd hate to see you pessimistic, Paul, after all of that. So next up is Brandon Milhorn. He is the president and chief executive officer of the Conference of State Bank Supervisors, the national association representing state financial regulators. And Paul is a champion of state financial supervision and the ability of the states to regulate within their lane. So Brandon.
Yes.
Yes.
So, I mean, look, it's not just that I'm a champion of it. We've been doing it. The CSBS been around since 1902. Since the founding of our nation, we've been regulating state charter banks, money transmitters, mortgage servicing, all state oversight. And for the last decade, the only regulators overseeing stablecoin activities in the United States. So yeah, I'm very proud of the work that our members do. And Katie, as you said, we were excited about the Genius Act framework. We supported a national framework for stablecoin activities, primarily for the reasons that Paul mentioned. It's important that innovation come into this space. It's important that consumers have access to products and services that are safe and responsible, that cut down on the cost of credit, that cut down on the cost of transactions. Stablecoins can be one of them, and the regulatory clarity provided by the Genius Act is incredibly important. And not just for new stablecoin issuers that are not banks, but for traditional participants in the financial system as well. And we think the benefits of blockchain technology, whether it's a stablecoin or a tokenized deposit, should be available for all institutions under a clarified regulatory standard. And so that's, to me, that's the real benefit of the Genius Act. Some of the things that we're looking for in the context of implementation: state and federal parity for issuers. Whether you choose as a stablecoin issuer to be a state regulated entity, whether you choose a federally regulated framework, we want those issuers to have the same ability to compete in the market, and the Genius Act contains that, and we just want to see that in the implementing regulations. We're also very focused on making sure that similar financial activities are regulated in a similar fashion. And that's important because earlier versions of the Genius Act started off with sort of broad authorizations for what issuers could and couldn't do. And that was narrowed down over time. The Act itself is about payment stablecoins, not about deposit stablecoins, not about lending stablecoins, about payment stablecoins. And if you're talking about a payment instrument, the authorization to issue, redeem, is incredibly important. That transfer of value, that trust in the ability to transfer value between holders is incredibly important. And when you limit those activities, the narrow authorization for those issuers, you can also have limited capital requirements, capital sufficient for ongoing operations, primarily because you've also attached to that a one-for-one reserve requirement. That protects consumers. That capital stack protects the uninsured asset. Payment stablecoins are uninsured assets. They are runnable. So that additional capital will protect. There's always going to be a little risk in reserves, even if it's minuscule, and a run could drive that down for an uninsured entity. So we're looking forward to seeing those same regulations applied to the activities of these payment stablecoin issuers. As I said, these are not banks. And the more stablecoin issuers are allowed to get into other activities, market making, lending, those losses can eat into capital and erode trust in the issuer, which would create the likelihood of a run. And that's something we're going to be very focused on as those capital risk-based reserve requirements in the context of the implementing regulations. And then the final thing that I'll say is that we have to watch very closely is the impact of stablecoins and these new technologies and new products and services on traditional bank activities. Not because we're here to protect financial institutions, but because of the implications of deposits moving out of banks. I think there's a Treasury study that was from earlier in the year that said the addressable stablecoin market will be $2 trillion by 2028. And if they're allowed to offer interest and yield, it could go as high as $6 trillion. Well, right now, the stablecoin market is about $300 billion. That leaves $1.7 trillion in money coming from somewhere to something else from banks. And right now, banks lend about 84% of their deposits. So that's $1.4 trillion in lending that might not occur, or more if we go up to $600 trillion. And while there is some lending in the stablecoin space, particularly as it relates to crypto and crypto-related investments, the activity that our members are concerned about is the lending to small businesses, the lending to America's farmers, the lending to local consumers. And if we see that deposit outflow from banks, think about the 80s. Think about the interest rate caps that were placed on banks. Money market funds didn't have those interest rate caps. When people were allowed to move deposits into money market funds and interest rates at banks were capped, we saw a significant outflow of funds. And then too late, regulators lifted the caps on interest rates at banks. Banks chased those deposits with higher rates, and then they got in a cycle of failures that led to, in many ways, to the savings loan crisis. I don't want to see that in the context of stablecoin. The technology is too important to have that happen here. So providing banks and stablecoin issuers with clarity on how they can participate and making sure there's a level playing field for that participation is very important, something we're watching very closely. And I will stand down at this point.
All right, and finally we have Paul Graywall. I'm thrilled to have him here today because he represents a quite important player in this industry. Paul is the Chief Legal Officer of Coinbase. Before joining Coinbase, he was Vice President and Deputy General Counsel at Facebook, and before that, he was on the federal bench, serving as a magistrate judge in the Northern District of California. Paul, we're thrilled to have you. The microphone is yours.
Thank you, Judge. Good afternoon, everyone. It's a pleasure to be here with you all. My colleagues have covered the waterfront nicely, and I think we can quickly move on to more interesting hard questions surrounding how to properly regulate this market. I will just offer a couple of additional observations before we begin to do that. One, when Paul mentioned the dumbest government relations campaign ever, I held my breath. And the reason I held my breath is I was vaguely recalling being accused of running exactly that just a couple of years ago by people who wanted to see crypto driven underground or out of the country altogether. It turns out we had some success in the last political cycle, in large part because we focused on getting the regulation right and electing public officials who understood that we are not operating on a blank slate. And I want to just remind everybody that when the Genius Act passed this summer, it was remarkable in many ways. Certainly, the bipartisan support for the legislation was unusual. We had overwhelming numbers in both the House and the Senate on both sides of the aisle supporting this legislation. But it was also remarkable in that for the very first time, at least in my personal and professional memory, we had Congress acting prospectively and not waiting until a crisis had emerged in a particular industry or asset class, to put in place sensible rules around who could issue payment stablecoins, what the reserve requirements ought to be surrounding that, putting in real standards around misrepresentations about the availability of federal insurance and the like. And all of this taking place before the crisis rather than after. So I do think that was remarkable. The other thing I want to just bring to everybody's attention, or perhaps for many of you in this room, remind you of, is that we are not at a point now where digital assets, cryptocurrencies, and even stablecoins in particular are a novelty in this country. More than 50 million Americans have now bought or sold a digital asset of one type or one stripe. Bitcoin has been around now for 15 years if I'm doing my math. This is not something new to the experience of many Americans. And if you talk to anybody under 35 or 40, this is just the water in which they swim. And so it's not surprising that when Congress chose to legislate, first with the Genius Act this summer, and we hope with the market structure bill to follow later this year or early next year, they were legislating in an environment in which you had real industries developing around these emerging technologies and real difficult choices for Congress to make around the role of the United States in that industry. Because stablecoins are popular now in the United States. They are even more popular outside the United States. And so a fundamental question Congress was balancing as it was making some of these hard calls that we will discuss is, how do we strike the right balance between promoting innovation here at home and developing domestic industry, while of course protecting consumers, protecting investors, and making sure that any systemic risks are dealt with appropriately. That's the landscape against which this legislation was enacted. And I think it's very important to understand and remember that landscape in the broader context as we think about ways to move forward from here. Thank you, Judge.
Thank you. Well, I want to start and get an industry perspective on something from both Katie and you, Paul, and then we'll turn and let the others chime in as free. But what do we see as the regulatory endgame here? Are we moving towards a system of national uniformity of regulation? Is that what industry prefers? Or is there space left for the states to operate and innovate, where we might have states emerge like Delaware did in the context of corporate law as thought leaders on the subject? I'll start with you, Paul, and then turn to Katie.
Right beside me.
Oh, that's right. Brandon's right here. Look, the states have and will continue to play a very important role in this space, not just for the foreseeable future, but I think long into the future and long past the time any of us are here to talk about this. I'll just highlight a couple of ways in which that's true. First of all, under the Genius Act, which deals with payment stablecoins specifically, it is hardwired into the framework and scheme that states will continue to offer a pathway for stablecoin issuers. And I do think it's critically important that there be parity, like for like. I think Brandon was a reference you made. That makes good sense to me, even if there may be modest adjustments around the edges to accommodate the different circumstances in which those issuers flourish. But I'll also just point out, Judge, that even with the Genius Act passed and with this market structure bill hopefully soon to come, this industry is extensively regulated at the state level. I'll just give you a few points of reference from my company's experience. For years now, we have operated as a money services business, an MSB, subject to oversight by the Department of Treasury. We have had money transmission licenses at the state level, in particular, as a counterpart to the MSB obligations, in something like 46 or 47 states. The BIT license, which the New York Department of Financial Services first made available a number of years ago, has essentially cemented the state of New York as the center of state regulation. Whether you like that or don't like it, it's just a reality for years now. And so I don't see any real question that the states will continue to play an important part of the scheme. I think the question is, how do we balance that ongoing relationship and role with what is clearly now a much more robust federal mechanism?
Katie, any thoughts?
Yeah, I agree with Paul. States have very capably regulated stablecoins, for example, since their advent via money transmission licenses. And although the Genius Act was required in order to formalize at the federal level and to allow for true innovation, the states have done a great job, for the most part, understanding the technology and allowing it to flourish. States also have really important roles in regulating other components of crypto that are unrelated to federal regulation. Creating new legal forms for crypto organizations to thrive is one. This is an area where Wyoming has been a leader. Defining property and creating ways that property can be debated and challenged and disposed of. Those are important things that states can do. The employment code that allows, for example, stablecoins to be used as lawful payment in exchange for work is something that states can legislate. And a lot of states have been very active in this regard. Like I already mentioned, Wyoming has been an innovator, but Texas has been close on its heels. And recently, Alaska has gotten very interested in crypto regulation as well. So there's plenty of room for states to be doing incredibly interesting things. And in fact, maybe we'll get a few ideas at the federal level from what states come up with in the coming years.
Lee, you gave us an overview of the Genius Act, but I know that you've spent a lot of time thinking about some of the issues that might arise, brand and flags, some of those as well. We've heard about potential deposit flight risk. As someone from a small town in Oklahoma where the community Main Street Bank is everything, I think that's a real concern for those in the heartland and smaller communities. There's also the issue that we've raised about payment on interest and yield, that big question. So what do you think are the top line problems that are going to have to be addressed in rulemaking and by the states?
Sure. So, I mean, if stablecoins grow as the industry expects them to, we have to ask the question, where is that growth going to come from? And I just want to posit that, look, the future is unknown and unknowable, and I think I could make a credible argument that stablecoins are a solution in search of a problem, and I think I could probably make just as credible an argument that stablecoins are totally going to disrupt banking and payments as we know it. So it's hard to attach probabilities there, and I kind of remain open, frankly, to everything. But I think we have to start with an acknowledgement of how stablecoins have been used to date, which I understand my friends in the crypto industry may not appreciate, but it's the analogy that they are the chips at the crypto casino, right? That thus far, stablecoins are primarily used to invest and trade in other cryptocurrencies and engage in on-chain transactions. And the data clearly backs this up. If you look at stablecoin market cap, that growth is tightly correlated to cryptocurrency prices. So I think the question going forward is sort of, will there be use cases beyond that? And again, I'm open to that possibility. I don't think they will come from domestic users. For most people in the US and other developed countries, payments work just fine, right? I just got notice from JP Morgan Chase that they're raising the price, the annual fee on my Sapphire Reserve card to $795. So people are willing to pay close to $800 just to use a credit card. Now, presumably you get, rewards for that, right? So most of us are fine with our current payment methods. Why would you want to switch to a stable coin that doesn't pay you interest, doesn't have fraud protection, doesn't offer float, and doesn't offer rewards? I think the situation changes, as I think Katie said, when you look on a cross-border standpoint and in developing countries with unstable currencies or histories of inflation there. But back to your question, Judge. So where is this growth going to come from if the growth, in fact, does happen? I think the answer will depend on whether or not third parties are continued to allow to offer rewards, which, I mean, in my opinion, it's the same thing as interest or yield to stablecoin holders. I think the risk there is pretty severe deposit outflow. If it persists, I think that outflow would largely come from community and regional banks. And community banks offer a disproportionate amount of small business lending and agricultural lending. And it seems as though the Trump administration is sort of working at cross purposes right now when it comes to supporting community banks. There's a op-ed in the Wall Street Journal last week, actually, from Senator Hagerty and Treasury Secretary Bessent, sort of defending Senator Hagerty's proposal to raise the deposit insurance limit to $10 million for all banks outside of the global systemically important banks. And they raised the point that community banks in the US, despite having 15% of assets and deposits, account for 40% of small business lending, and I think 90% of agricultural loans from within the commercial banking sector. So clearly they view that, that proposal to raise the deposit insurance limit as something that could be beneficial for community banks in preventing this deposit outflow, while at the same time permitting this payment on interest loophole. So I think that's something like we should be concerned about. Not that I'm carrying water for the banks. I mean, I used to work as a bank examiner, right? It's not a job you enter into if you think banks are God's gift to earth. But there are, knock-on impacts, right? Specifically on credit intermediation, because essentially, if you're holding a stable coin instead of a bank deposit, what you're deciding to do is rather than provide credit to the bank, which will then provide credit to the community, you're providing credit to the U.S. government, and you're enabling, frankly, an unsustainable fiscal trajectory. Now, that should really factor into your decision whether to use stablecoins or not, but that's just the reality of the situation. So, again, we don't know how this is going to unfold, but I think a lot of policymakers right now are very concerned about deposit outflows from the community banking sector, and I think they're right to be worried about that.
Well, Paul, I want your thoughts on this topic as well, because Paul Watkins, we have two Pauls over there. I have to specify when I look that direction, because I know near and dear to your heart is maintaining the appropriate, state and federal balance and regulation. How do we do that? I mean, is the Genius Act, is this indicative of success in the regulatory space, or is it a red flag and warning sign from the perspective of the states?
Well, to that question, I guess, look, I'll take a dramatic, clear position. I'm going to predict the end of national federal financial regulation. I don't think it's sustainable in a politically divided country. The way these agencies were sold to Congress and the American public is we're going to have non-political technocrats who are separate from the political process. We're going to give them a lot of discretion, and they're going to be able to interpret really broad terms and have broad supervision and enforcement authority. That's not the situation that we have today. We have agencies who are directly politically accountable. So that means we have made political actors have tremendous discretion over the lifeblood of the economy. And that is an irresistible political honeypot for anyone who has the presidency. And we know the country is becoming more divided. We've seen how this played out in Obama with choke point. We see how it played out under Biden with the whole of government approach to climate, with the whole of government approach to squash crypto. And I think for folks on the left, do you really think that there will never be a Republican administration that targets liberal institutions through this unbridled discretion in the financial system? You probably don't. You're probably worried about that. I think both sides are worried about that. And so we need a different structure. Where are we going to find those checks? There are some encouraging signs in the Genius Act. There's more ability to sue federal regulators, not enough, but there's some ability to do that. There's some role for states. We need a state safety valve that is a real safety valve. So if those federal regulators go off the rails, it's possible to default to a state system. Because I can tell you a state regulatory system can actually overcome political differences. We do it in insurance. There's no federal insurance framework. Regulating insurance is far more complicated than regulating stable coins, in my opinion, and it works. So I think that is going to ultimately be the future. And we need to go farther down the road of independent state chartering authority. Right now, the state authority is in the Genius Act is capped at $10 billion, which is a similar cap for banks. $10 billion in transaction volume is far less than $10 billion in deposits. So that is a pretty limited role. And outside of that, you're depending on federal discretion. It's a partnership that's kind of like the FDIC and the state regulator, which again, the state regulator is not strong enough to stop something like choke point if the FDIC wants to execute it, or there's discretionary waivers, which again is up to the federal agency. So I think the system we have does not work for folks that are directly politically accountable to the president, and we need to change it.
Well, Brandon, there's a lot of flesh to be put on the bones of the Genius Act. We're anticipating a lot of rulemaking and guidance coming down the pipeline. I know your entity just filed comments yesterday on the Treasury stablecoin flag the important rulemakings that are coming and the concerns that are raised by those rulemakings.
Yeah, maybe I'll start with your earlier question about what's the role of the states here if we created sort of a monolithic federal. I don't think that's so. And I think even the beauty of our dual banking system is that our federal banking agencies have their views and the states have theirs. States actually, I feel like, are a little bit more locally, politically accountable. Most of them have economic growth as part of their mission, not just consumer protection and safety and soundness, but also economic growth, and that affects their perspective on the success of the financial institutions. And the differences in the states allow innovation. And that's why we have stablecoins now, is because states stepped forward when the federal government wasn't prepared to act. Now we have a national framework for the Genius Act, and that's good. That's going to provide some good regulatory clarity. But we don't think that means it has to be absolutely consistent and only one way. We think there's flexibility for states to, it doesn't say exactly the same in the Genius Act, it says substantially similar. States are allowed to exceed the national floor relative to some of the standards in this Genius Act. I think you'll see states take advantage of that opportunity. And what's powerful about the dual banking system is that gives consumers and financial institutions choices of where they operate, choices of the business model that they deploy. I think we'll see that in the context of the Genius Act. It's a powerful component. And while our federal agencies do sometimes overreach, Paul, we think that partnership can work in the context of stablecoins as well. For example, in the context of the $10 billion threshold for federal supervision, there's a waiver provision in there. We think states with the authority to regulate and supervise stablecoin entities with substantially similar frameworks that are annually recertified by the state SCRC should be granted waivers, I think, in a pro forma fashion almost. I would say from an implementation standpoint, we're going to be watching very carefully the interest and yield regulations that come out of the federal regulators. We're going to be watching very closely the capital sufficiency requirements. You know, one of the interesting components of the Stablecoin Act is it narrows the Financial Services Authority of issuers. And then it also allows them to seek the ability to also serve as a digital asset service provider, which is sort of a broader authority, a little bit more akin to sort of a custodian, maybe of an exchange. And we don't think that should be granted as a matter of course. We think that regulators should think very carefully before they authorize an issuer to engage in digital asset service provider activities. And if they do, then capital requirements should scale. You know, we don't want to create another FTX. You know, we don't want the lending and market making and the challenges associated with that. We want to be able to constrain that. That requires good risk management, a strong business plan, and strong capital requirements. And if entities are able and willing to do that, then I think they can step up and do it. So we're going to watch that very carefully. I think those three things: the substantial similarity with the waiver, the interest and yield discussion because of the impact on deposit outflows, and then ultimately the discussions relative to the authorities of issuers and how capital and reserve requirements are maintained.
Can I just push back on the first part of that?
Very briefly.
Okay. So if we have the regulators that we had during the Biden administration, there will be no waivers. The federal charter will be ruined because they'll add requirements, and then they'll say the state charter is not substantially equivalent. And I think that is not a stable enough foundation to build an industry.
Katie, thoughts there before a question I have for you?
Sure, yeah. Brandon is alluding to a discussion that's happening both in the comments right now and in the newspapers right now between the bank industry and the crypto industry. Specifically, the Genius Act prohibits the payment of yield by issuers directly to consumers solely for the purpose of holding the asset. It actually doesn't say anything about whether exchanges like Coinbase can pay out rewards to holders of the asset. And in fact, because programs like that have been going on for some time and were in the minds of Congress as they drafted this legislation, it's very clear from the face of the statute that Congress intended for exchanges like Coinbase to continue to allow, or to continue to pay consumers rewards. The banks actually have now come in with a strongly worded comment or two alleging that that wasn't Congress's intent at all, and in fact it would derail the financial system or something of that nature to allow exchanges to continue doing this. I would recommend to everyone a terrific comment that Professor J.W. Barrett filed, I think yesterday, on this exact topic, essentially going through all the times that the banks have encouraged financial regulators to stay totally within the contours of congressional statute, except now, when they would like us to rewrite the intent of Congress and prohibit the payment of yield or rewards to consumers by exchanges. So I think this will be something for us to debate here on this panel, because I think Paul and I probably agree that Congress knew exactly what it was doing when it wrote this provision, and we should stick to congressional intent.
Well, I will say, Katie, all we have there are the words of the statute. We don't have a significant legislative history around this provision. We have as it's drafted.
Fortunately, they are clear.
Yeah, well, okay, well, you tell me. It doesn't just say interest, it says interest or yield. So what does yield mean? Well, I looked up yield last night. It means the produce of an entity. It doesn't mean interest. So it's something, yield means something else. What does it mean to solely as a holder? What's the prohibition relative to solely as a holder? And then there's an evasion provision at the end of the statute that says an issuer can't evade the prohibitions and requirements in the act by working through a third party. And so I think you've got to, and while I certainly respect your view here, I think you've got to read those provisions in tandem, read the section as a whole, and how that's implemented could have a significant impact on how the market works. And look, it's a choice, ultimately. Congress made a choice, regulators made a choice, are going to make a choice, and we'll need to see where that comes out. But the consequences, as Professor Reiners points out, could be significant for banking.
I don't think there's much of a disagreement or dispute about what yield means relative to interest. I agree completely, going further, that it's important to read the plain language of the Act. And the Act is crystal clear that the restrictions on the payment of either interest or yield applies to issuers. Issuers, not digital asset service providers, who, by the way, are defined and addressed elsewhere in the statute, and were very specifically excluded from any limitations or restrictions on their payment activities. The other thing that I think is important to bear in mind is that, as I think Brandon and others have pointed out, the restriction on issuers applies to yield or interest payments solely for holding or using the assets. That was also a very conscious choice, and I couldn't agree more. The legislative history, the formal legislative history, is not terribly detailed on that particular point. But if you all would just like to know the conversation that was happening literally in the room, and as the red lines were being exchanged, that was a very intensely debated point. So Congress always retains the prerogative. I don't think anyone here can credibly dispute that. But they made a very specific choice a handful of months ago to strike this balance between, yes, imposing restrictions on the one hand to protect investors and consumers, but also promoting innovation. And to upset that balance in the middle of rulemaking, literally happening right now at Treasury, and even as the dust is still settling on this act, I think would be a terrible mistake.
Well, can I jump in, Judge, real quick?
I'm going to turn to you
Okay,
for this question here, and you can chime in there. But Paul, you predicted the demise of federal regulation altogether. But my question, with these rulemakings coming, and this yield question is obviously a critically important rulemaking that's coming, how much confidence should we have in the federal regulators and their competence in this space? I mean, that's a real question for those of us who don't live in this world. We begin to wonder, I mean, is industry worried? Lee, should they be worried?
I'll let industry speak, answer that question. I think as a former federal regulator, I am obligated to say that they are competent and up to the task here. I mean, I think Look, I agree with Paul Grayball that, there were obviously very specific and intentional word choices made, which I think the outcome was that it was intentionally vague so that sort of multiple parties could see what they wanted to see, frankly, and get to as many yes votes as possible. The language is what the language is. I think I do agree that if Treasury and the federal banking agencies do try to restrict the payment of interest or rewards from third parties to their customers, I think they would be probably on shaky legal footing post-Loper Bright, certainly. So I think if it's going to be addressed, I think it's probably going to have to be addressed through Congress in the market structure bill. And one of the arguments that the crypto industry made in the Genius debate about why you didn't need to sort of extend the prohibition of third parties is that, well, market structure will regulate the third parties, and we can deal with it there, right? And now market structure may not happen. But I think Congress's intent was clearly, it says payment stablecoin, right? So Congress clearly envisioned stablecoins being used as a medium exchange, not as a store of value. Governor Waller has acknowledged that. Senator Rounds. So there is senators from both sides of the aisle who say this needs to be fixed one way or the other. And even a simple term like hold. Well, what does that mean? If you look at the relationship that Circle has with Coinbase, they have a distribution agreement. Circle was very clearly laid this out in their S1 that they filed to go public earlier this year. So Circle pays approximately half of their reserve revenue to Coinbase per an agreement they have to distribute USDC, and then Coinbase will offer rewards to their users who hold USDC on Coinbase. So who's the holder in that situation? If it's held in a wallet that is on the Coinbase platform, meaning Coinbase controls the private keys, is Coinbase the holder in that situation? In which case they're getting interest from Circle, perhaps illegally, according to Genius, or is the customer the holder? So, there's still a lot of outstanding questions here that presumably will be litigated at some point, but I just don't see how the Treasury or the banking agencies on their own could go out and restrict these third parties from offering rewards to customers. It's going to have to, I think, be Congress and then litigation to a certain extent.
Katie, any additional thoughts there?
Coinbase as holder of the assets is an interesting version of the argument that I had not heard before, but it is still wrong. I think that
it was a question.
Yeah, look, many of us were in these conversations as Congress was debating this issue. The intent of Congress was not only clear during that process, but the statute itself and the wording of the statute is clear. As any good conservative knows, you don't even need to look to the legislative history if the statute on its face is black and white clear, and here it absolutely is. Issuers are not permitted to pay interest or yield to holders solely for holding the asset. That's it. It doesn't say anything about other parties. It doesn't say anything about exchanges. It doesn't say anything about Coinbase or anyone similarly situated.
And you've conveniently left out the evasion provision.
The evasion provision.
I appreciate that.
No, fair. Yeah, you made this point separately when we were talking before, but the evasion provision is part of any large, sprawling financial legislation like this. It's sort of a savings clause, so to speak. It doesn't have anything to do with this particular provision and wasn't intended to be connected to this provision in any particular way. You need to include those types of catch-alls in legislation like this, but again, the face of the statute is really clear on this issue. And I think the more telling point is that exchanges like Coinbase have been paying rewards for years on stablecoins. Congress knew that fact when they drafted this statute and had every word in the dictionary available to them to be clearer than they were. Instead, they decided to allow these types of payments to be made.
Congress is never not clear.
Can I offer one more point? And this is we're setting aside now the language of the statute, but there is a consumer protection issue here. When I look at some of these reward programs, and this time I'm not talking about Coinbase, it's not entirely clear where the reward or yield is coming from, right? And if it sounds too good to be true, it probably is. And we've been down this road before in 2002, right? I mean, the Gemini Earn program, Celsius, right? BlockFi. So these sort of crypto yield-bearing accounts, have resulted in significant consumer harms. And I'm just not entirely clear where these platforms are generating the revenue to pay these rewards. And the premise of Genius was that this was supposed to be sort of effectively narrow banks, right? So, you take dollars, you just store those dollars in high quality liquid assets. And because there's no maturity transformation, liquidity transformation, you don't need the full suite of prudential regulatory requirements. But if sort of that credit intermediation is happening in some other corner of the crypto economy, there is real risk out there that is not being accounted for in the system. Now, presumably and hopefully market structure would address that piece of it. But I think that some of these programs, these reward programs, are sort of destined to fail as they have in the past and result in pretty significant consumer harms.
So we certainly welcome, I heard I forget exactly who said it, some welcoming of federal regulation before the crash, before the crisis. But what does this act actually do to protect the consumer from the next 2022? It was Terra. We've had a few of these along the way. What does the Genius Act actually do to represent the guy on Main Street with an investment? Because this isn't a bank. We don't have full ironclad FDIC backing. We just have this one-to-one ratio that we're relying on. So, Paul?
Judge, the Act actually speaks to that last point head on. To the extent anyone out there is representing that there is FDIC insurance or other government backing, you're violating the Genius Act, and you can be held accountable for it. I think the consumer protections are significant. I'll highlight just a few. One, before the Genius Act, there were no federal requirements regarding the composition of the reserves backing these assets. And so while one would hope that an issuer holding out that the dollars were being held in appropriate accounts and were immediately redeemable and accessible, there was no backing, there was no force of law behind that. Genius addresses that. There are very specific short requirements for reserves that include cash and short-term treasuries and the like. The other thing is that consumers, as a result of the Genius Act, now have explicit redemption rights. That's an important next step in ensuring confidence in these particular instruments. And I would say, another critical, important consumer protection that comes from this is that there are now mandatory audits required of any payment stablecoin issuer on a monthly basis. Whereas before, it was left to the good graces of issuers to tell people what was in these reserve accounts and whether or not they were as they were represented. Now, by force of law, those representations need to be backed by formal audits and disclosed every single month.
All right. With that, we are going to leave a little bit of time to take questions. So if you have a question, make your way to the microphone with one caveat. No soliloquies, no Justice Breyers at the microphone today. Let's just have questions. So we have a question here.
Great. Thank you. My name is Coach Winehouse. I'm the Executive Director of the Cryptocurrency Anti-Fraud Education Association. And my question, it relates to an article Ms. Biber wrote, so anyone can answer the question, but I'll address it. Ms. Biber, you recently wrote an article attacking the one heavily regulated industry actor that is licensed for taking cash to onboard the underbanked into digital assets via ATMs. Do you think that by jumping on the bandwagon with the state and DC attorney generals against the one non-participant in gross fraud in those transactions, you are sacrificing access to digital assets by the millions who most need them that those ATMs have served?
Thanks for asking that question. The facts of this matter show that those ATMs are not actually used by the unbanked. They're used for scam purposes. I would encourage folks to take a look at the lawsuit by Brenna Bird and by the DC Attorney General. It's important, I think, for the cryptocurrency industry to call out the worst components of the industry, and this is one that I simply think cannot be defended.
Thank you. Next question. You're up.
My name's Devin Watkins. My question has to do with the one-to-one. I don't understand the purpose of that for bank entities if they were to create stablecoins. I understand that non-bank entities creating stablecoins, we may not be able to trust them with doing fractional reserve banking to be able to do that, hold appropriate reserves. But I would think with traditional banks, if they were to issue stablecoins, they should be able to do the kind of fractional reserve banking and lend out some of that while still having sufficient reserves in case there was a run on the currency. So why isn't that allowed?
It is. It's called tokenized deposits.
Okay.
So I mean, it's a deposit that exists on chain.
I think another important consideration, banks aren't allowed to issue stablecoins under the act. Only a subsidiary of a bank can issue, and even if you were an insured entity, with the tokenized deposit, the liquidity demands relative to a payment instrument are greater, I would say, than a normal deposit. In many ways, the one-for-one reserve requirements is very similar to money transmission rules that the states have in place. And that protects consumers as their money comes in to the system, gets transferred, and then flows out of the system. So those reserve requirements are important. They're also important in the context of a liquidation or a resolution scenario. And if you have strong liquidity requirements, and you have strong capital requirements, maybe you can avoid a resolution scenario in which stablecoin holders lose value on their stablecoins because they're liquidated in advance. We think some planning on the front end. So that, to me, is the primary difference. I will say it is important to give banks guidance on how they can engage in the system. What is the impact of holding reserves? What about tokenized deposits? What are the liquidity rules that are going to be in place relative to tokenized deposits? One of the things that CSBS did, in addition to our letter that we wrote to the Treasury Department on their ANPR, we sent a similar letter to the federal banking agencies asking them for guidance on tokenized deposits. The ability for banks to innovate at the same time non-banks are innovating in the digital asset space, we think is incredibly important.
All right, I'll take the next question over here.
Yeah, Ken Rosen from the University of Alabama School of Law. And because I'm a securities lawyer, I guess I have to make a disclosure. I guess this question comes from my experience working at the SEC. Don't worry, long before Gary Gensler. And also,
go on.
my current experience representing Alabama on the Uniform Law Commission, the state regulatory world. I appreciated this as a FedSoc panel. I enjoyed the vigorous, sort of interaction of people on the panel. I think you all would agree, though, from the comments you made, that certainly the Genius Act leaves ambiguity, leaves questions to answer. In my experience, I think in the regulatory community, I think we need laws and regulations sometimes to clarify. But just as important, but underappreciated, is we need people with expertise to actually be the interpreters and the appliers of those rules. I think the judge asked a question that kind of got a little bit to this, but I guess I would ask the panelists to maybe say what you're actually doing to, shall we say, help the regulatory community become more informed about the technicalities of what they're actually regulating.
If I can jump in, Judge?
May Paul.
I'll offer just one example of what we're doing, because I agree with you. Little of this matters if we don't have competence, indeed expertise, at each of the respective agencies involved in this. Maybe the shining star example, certainly from the last 6 months or so, is at the Securities and Exchange Commission. The Crypto Task Force, which is led by Commissioner Peirce, has done an outstanding job of aggregating expertise across the agency and from outside the agency to look at where can the agency move quickly, even as legislation is taking form, to provide a more stable environment, to promote innovation, and ultimately to provide stability to an industry that sorely needs it. The roundtables they've convened, publicly broadcast, the transparency around who's coming into the SEC to meet and to talk about what issues, all of this, I think, has been a breath of fresh air, to be sure, but also an excellent example of what we would hope to see elsewhere at the federal level, frankly, across the nation, as each of these different agencies takes their own particular role in this ecospace.
Judge, you mind if I add one thing? So wonderfully, competence reigns again in the federal government, but one thing that has stymied federal regulators for quite a while is the draconian ethics rules that prevent folks who work at places like the SEC from holding even 1 cent of crypto. This would be tantamount to saying you can't regulate Google if you have a Gmail account. And as Venmo or PayPal move to crypto rails, as games include more and more crypto components, federal regulators are going to be completely unable to use objects of basic commerce. So for those who have a role to play in the federal ethics rules, I would strongly encourage to take a look at these issues and create more flexible allowances so that folks who are handling and regulating this technology can actually lay hands on it in a meaningful way.
Can I also add one quick thing to that? This demonstrates the problem with putting everything at the federal level, where the process is no, 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 yes, national market. Where's the data come from? How would any regulator know what they're doing? What should have been happening is that these products were launched in a comprehensive way in states. If you put Florida and Texas together, that's basically as large of an economy as Germany. That's the 4th largest country in the world. We could have had this product developed in a meaningful way over the past decade, but everybody was afraid of being sued for being in the business of banking. So these decisions need to be pushed downward for us to be able to make data-driven national rules. The only way you get that insight is by allowing folks to pilot these sorts of things.
Thank you for your question, Professor. I'll turn to this microphone.
Yes, hi. Michael Curry from Philadelphia. This is a little bit of a loaded question. Speaking as a general counsel for a regional state chartered bank, what should a regional state chartered bank be doing now to either defend against or prepare for this new scenario? Except lobbying. We know we have to do that.
Brandon, that felt aimed at you.
Yeah, other than that. Well, this is a Brandon or a Lee
I represent
question.
your supervisors, not the banks. I will say, one, you need to be thinking about the implications for payments in the payment space. I think you need to be thinking about whether reserves or holding reserves is an option for your institution, or do you need to be exploring in a little bit more granularity the ability to use digital assets to support your customers, whether in a tokenized deposit framework or as a consortium. Those to me are the questions there. I think it's probably more front of mind for entities that are doing international transactions or remittance activity, large cash transactions. But if you're not thinking about, and it's not just digital assets for all banks, it's how are digital assets going to impact my business model? How will new technologies in the fintech space affect my business model, and how am I going to take advantage of that? I think one of the challenges we've had, and Paul, I think, references is, for too long the federal agencies were hands off with innovation and just wanted to say no and keep innovation out of the financial institutions. I said to a group the other day, every morning I get on 66 at Falls Church, and there's a dual ramp with a stoplight. And if I can time it just right, the person that's at the stoplight can change the light for me, I can just blow by them. I'm really concerned that we're going to set that same framework up in the context of non-banks. They've got the momentum. A lot of the innovation has been occurring outside of banks because of limitations from regulators on banks engaging in this space. We need to get them up to speed so they can compete on a level playing field. That's incredibly important for our members. We need to keep pushing the federal agencies in that space.
All right, thank you for your question. We have about 10 minutes left. I think we can get everyone's questions answered if we move efficiently. Next question.
Sure. Michael O'Connor, Cloudburst Technologies. Before that, I was head of litigation at Kraken, where I personally had Gary Gensler served the afternoon of January 20th. He threw the subpoena on the ground and slammed the door in our process server's face, just for information. The question for the panel is, do we really have a dual banking system if the Federal Reserve can gate essential services behind a master account and unilaterally deny those master accounts?
Well, maybe I'll start. I'm not going to get it.
I can chime in too.
The master account framework is incredibly important. That's going to be, the Genius Act is silent on that. I think it's something we're going to have to look at. Certainly Governor Waller has expressed an interest in looking at things like skinny master account access. We're going to see how that goes. I will say we do have a robust dual banking system in the United States. 79% of our banks are state chartered entities. 92% of those banks are community banks. We have a robust money transmission. We have robust mortgage origination and servicing in our dual banking system. So I would say we have a strong dual banking system. The question, I think, is how we sustain it without the federal government taking over and limiting choice. And that, to me, is the biggest concern we've got to think about as we implement laws like the Genius Act.
It's a great question, a bit of a loaded question, but still great. And it gives us an opportunity to talk about a really important issue, because I do think that the potential of being a permitted stablecoin issuer will be, unfulfilled if they're not able to get access to a Federal Reserve master account. I mean, so they'll have to have a third-party banking relationship to facilitate the sort of the fiat stablecoin conversion. Look, there was a recent case that I'm sure you're well aware of. A panel in the 10th Circuit ruled in favor of the Federal Reserve Bank of Kansas City and the Federal Reserve Board, saying that despite Custodio, which is a Wyoming special purpose depository institution, despite them being eligible for a master account, the Federal Reserve ultimately has discretion to approve or deny those applications. I think I agreed with that ruling. The Federal Reserve is a payment system operator, and that means that there's risk involved in doing that. A few years ago, they did create this sort of three-tier framework for assessing master account applications. They're going to apply the highest standard of review to applicants who are state chartered and non-FDIC insured and not regulated by a federal banking agency. That makes sense to me. But I do think Governor Waller's skinny master account idea is a worthy idea. I mean, I'd like to see it fleshed out a little bit more before I sort of weigh in definitively on it. But it makes a lot of sense, frankly, that you sort of provide a master account with all the bells and without all the bells and whistles to some of these stablecoin issuers. So, no intraday overdraft. You don't get interest on reserves. Maybe you cap balances. But I think if we're going to, if stablecoins are going to live up to their potential, I think they probably will need a Federal Reserve master account. And the skinny idea might be a good place to start.
Thank you. Thank you so much for that question. Next question.
Hi all, thank you for fielding these questions. And my question is, because the panel was ingloriously talking about the regulatory scheme.
Get a little closer to the microphone. We're having a little trouble hearing.
And we were talking about the regulatory scheme around stablecoins. My question is this. Given that the Genius Act now defines a statutory framework for privately issued stablecoins, do you think that U.S. monetary and regulatory policy should protect it through federal preemption or through state-level innovation and supervision? And I think the other way you could say it is, where should that line be drawn between federal preemption and statewide innovation?
You're speaking my language now.
Is that your cousin, Brent?
We'll pay you later. We've been debating federal preemption of state authorities in the financial services space since Jefferson and Hamilton fought over the first national bank. I am proud to represent the states in this space. One of the things that I think about a lot is the National Bank Act and the OCC's authority relative to establishing national banks. We may not like the fact that the OCC has preemptive authority with respect to national banks, but Congress passed the law. But I think you have to consider that these authorities, the authority to regulate financial services, has always been exercised by the state since our founding. And we need to respect that role. So, for example, when I look at federal statutes like the National Bank Act, one of the questions is, how are you intruding on state authority? Are you following the process and the standards specified in the National Bank Act? And that should be interpreted narrowly. And so things like a national trust charter. The OCC clearly has the authority to set up a national bank. It clearly has the authority to set up a national trust. We don't think they have the authority to set up a trust that acts like a bank. And so there are several applications now pending to set up national trust. We think we expected, I think, that outgrowth in the context of stablecoin regulation because of the custody, the ability to custody reserves. But the activities of those agencies or those entities and how their business models form is going to be very important for answering the very question that you just asked. What is the line between federal and state, and what is the appropriate role vis-a-vis the federal government as it relates to states? And that is a debate that is going to rage on for hopefully, 250 more years in the United States.
And that's one that'll likely end up in the courts. Congress hasn't preempted the field, so we're in conflict preemption world, and we know where that ends up. So thank you so much for the question. Last question.
Hi, my name is David Latt. I'm a journalist. I have a Substack newsletter called Original Jurisdiction. I recently wrote about crypto, and Katie was a great source. So I have a very quick question. I think one thing that the panelists have alluded to is how things really shifted under this new administration and under the new SEC, not under Gary Gensler. How much of this is a new and lasting era for crypto regulation, and how much of it could be walked back if Congress, well, if it ever gets back to returning, how much could be rolled back if the White House and or Congress changed hands?
I think a lot of it could be rolled back, but I would put this in perspective of you can't just look at Democrats in Washington, D.C. So Democrats in New York had a very different perspective than Republicans in Wyoming on how to regulate crypto. And they started out with something that was unworkable, but you know what? They fixed it. And so that is my hope for the durable future in Washington, D.C., that Washington, D.C. stops being the outlier, frankly, among all Democrat regulators all over the country, where you can talk to California, you can talk to New York. The one place you cannot talk about crypto to a Democrat is Washington, D.C. That never made sense, and hopefully that was a historical anomaly.
One of the things that is so frustrating to our members, in the states, what my members want are stability and consistency. And I think they expect financial services regulation to move after elections. Elections have consequences, but the tremendous political swings that we've seen recently in Washington, they have real consequences. First of all, for our members, but certainly for our financial institutions, if they are constantly whipsawed between one administration to the next on these rules. When I was at Raytheon, we used to say it's not red or blue, it's green. Businesses just want stability. They just want certainty so they can go out and do business. That's something I think the federal agencies certainly have to think about, and something our members talk about. We talk about a resilient framework for financial services in the United States. I hope we can get to that and avoid the political swings that accompany some of the more recent activities.
If I could answer that question just from a political standpoint as well. I think only a few Democrats back in the day were brave enough not to follow Elizabeth Warren and Gary Gensler right off the old cliff. But I think in the intervening year, the Democratic Party has shown a desire to pass crypto legislation, to regulate crypto in a way that allows the industry to thrive and engage with the industry in a really meaningful way, which many of them have been doing as we discuss the possibility of market structure legislation. So I'm actually optimistic that we're not going to see a complete whipsaw on these issues if Democrats take the White House again. frankly, I think politically Democrats learned their lesson. There's a good argument to be made that one of the reasons why Kamala Harris lost the election was because of the Biden-era anti-crypto policies. The data actually shows that crypto voters could have moved states like Pennsylvania and probably did in other states. So politically, I think Democrats have learned their lesson. And I think substantively, many of them have now taken the time to understand this innovation and to get familiar with it and lay hands on it and are excited about what it offers for the future. So while I agree with Paul that there are some areas of the law where I fear whipsaw on the part of the Democratic Party, I think this is maybe not going to be one of them.
And the strong bipartisan support of the Genius Act.
And the strong, thank you, yes, and the strong bipartisan support of the Genius Act.
Demography is destiny.
Exactly.
The Democrats realize that the under 35s want crypto in their future. They want to see sensible rules
Exactly
passed
right.
at both the state and the federal level. They're not going back.
David, thank you so much for your question. I've enjoyed your content for years, been a reader since the early days. There you go. And that is a good place for us to wrap. We've used all our time, but first, an important announcement. At 1:30 p.m., aka right now, Justice Amy Coney Barrett will be signing copies of her new book, Listening to the Law. Copies will be available for sale on the concourse level outside the cabinet room where the signing will occur, and the signing will conclude at approximately 3 p.m. And with that, thank you so much for my wonderful panelists. It was an honor to share the stage with you. With that, we're done.
Judge Weirich.